All right, let's go ahead and get started. Recording is on. So today, what's going to be very important is you need to have the Excel model that you did in our last class a few weeks ago before spring break. And essentially, we are going to continue on and finish up the valuation of Nvidia. It'll be very important that you match everything that I do during class today, because I'm not going to give you this file. And so again, you have to create this file, otherwise you won't be able to do the future assignments. You have to do this individually, right? So your goal today, again, is to do everything that I do, you're going to do, and if you complete the Excel file that we've done, you can submit it as your next homework assignment. If not, you have until Monday, 10 a.m. to submit that. Okay? So while you're getting that file out, here's the sign-in sheet. Please make sure you sign this for today before you leave. And a reminder that the second half Bloomberg Trading Challenge has started. So again, if you haven't started as a team, you have until the end of the day today to get below $300,000 in cash. Okay? So again, it's the 2H second half. Should be on the drop-down menu for the section. Anybody having trouble with the Trading Challenge? Getting there? Same teams. So we go through this. Yes?
Is there like a 10 long minimum?
Yep, same rules. You got to have 10 longs, and you got to stay below 300,000 in cash. And if you want to recreate your previous portfolio, that's up to you. But again, we've all started from scratch on the Trading Challenge. All right, any other questions about that? All right, so let's talk about this valuation model. So again, where we stand today is we have data that was downloaded from Bloomberg, okay, on Nvidia, which we created in this model a couple of tabs for a standardized income statement and balance sheet. And then based on the standardized income statement and balance sheet, these were converted into TFIs, TIIs, CFIs, and economic profits. Okay? And we then took a series of ratios and we forecasted the ratios. And we said, assuming these forecasted ratios come true, we created forecasted income statements, balance sheets, and basically forecasted economic statements, including the most important one, the CFI. What we're going to do today is we're going to, using Modigliani-Miller, basically finish up an enterprise DCF valuation model, okay, in this case of Nvidia. And we're going to do something called the As Is model, okay, which means their share price is right around $900 a share. So we're going to make sure that our model matches that current share price. Okay, that's called an As Is. So it'll set up a baseline for the valuations that we do. And going forward, you will always create an As Is Excel model valuation for a company. Right? This is a step most people skip in the real world. But the idea is, if a company's worth the sum of its future cash flows, if we know the cash flows, we know the price. Well, here we're working backwards. We know the price, so we're trying to figure out what are the cash flows that lead to that price. That's called the as-is process. And it'll establish a baseline, because then next week we'll do what's called a target price, which is what we think the share price should be, and then we'll adjust the cash flows to what we think the price will be, and that will create the buy-sell-hold opinion. Okay? But to get there, we got to finish up our model. So our next step, now you're copying what I do, is we're going to create a new worksheet tab called DCF Valuation. I'll make this the last tab in the last worksheet in my model, and I'll make it a little bit bigger so it's easier to see. All right, so Modigliani-Miller, operating value is based on free cash flows. The forecasted free cash flows are on our CFI, okay? So starting in cell B1 on this new worksheet, free cash flows, I need the forecasted free cash flows. The first year forecast, cell A2, equals, from the CFI, H2, equals previous year plus 1 for 2026. And we're going to do 5 years worth of forecasted free cash flows here. Now our model actually has 6 years of forecasted free cash flow, but we're going to use the first 5. And part of it is an answer to a final exam question. So what the book talks about, is best practice, is that you generally want, when you go into what's called perpetuity or continuing value, you want the firm to be mature or stable. That's ideal. Okay? So you basically need to forecast enough years so that when you get to that perpetuity period, the company is kind of mature. It just helps your valuation models become more straightforward. Now in this class, we're going to arbitrarily just do 5 years, right? Nvidia, unlikely to be mature at the end of year 5, okay? But we're just going to arbitrarily do it. So we might want to do, if we're really doing this, like 10 years of forecast for Nvidia and then go into perpetuity. But just arbitrarily, we're going to do all companies for 5 years. Just understand that's a shortcut we're taking this semester. But the point is, when you do that perpetuity period, you always forecast an extra year in your model. So in our case, year 6, the T+1 year, is the beginning of the perpetuity period. So the first 5 years, we forecast year by year. Year 6, perpetuity. Okay? We have a forecast for free cash flow, assuming those ratios come true, for the next 5 years. So the 2025 free cash flow forecast for Nvidia, B2, equals, from the CFI, column H is 2025, free cash flow is row 14, so H14, off the CFI. For 2026, equals, just transposing here, off the CFI, I14. For 2027, off the free cash flow, CFI, J14. Free cash flow forecast for 2028, off the CFI, K14. And for 2029, off the CFI, L14. Assuming, again, our assumptions come true, and I'm going to format this to $, 1 decimal place. These are the next 5 years of free cash flows. Okay. Now, if I'm trying to do the operating value, I need to present value these to today, so I need to turn these into present values, right? Now, again, I'm kind of old school, so I use the discount factor approach. Present value, cash flow divided by 1 plus R to the N or T, or you can take the cash flows times 1 over 1 plus R to the N or T. That's the process I'm about to use. You do this in Excel if you want, but here's the point. They're called discount factors. And if I take my free cash flow times the discount factor, I get my discounted free cash flow. All right, so equals 1 divided by left paren 1 plus the R. The R is the discount rate. In this case, it's the WACC. So assumptions B4, right paren. So if I take the 45,790.8 and I multiply it by the 0.9099, etc., the present value of that cash flow, 41,665.84. Right. So I'm going to do this for the next 4 years. But when I go to the second year, the discount factor is 1 plus R squared, 1 plus R cubed for third year, etc. So when I copy this down, I'm going to edit this cell. I'm going to put a $sign in front of the B and a $sign in front of the 4, because the WACC is an absolute cell, absolute reference. I'm going to copy that all the way down to C6, paste. And then starting with C3, it's 1 plus R squared. So at the end, shift 6, 2. In the third year, it's 1 divided by 1 plus R cubed. So shift 6, 3. Fourth power, shift 6, 4. Also known as the caret. Fifth power, caret or shift 6, 5. So that if I take my free cash flow times discount factor, present value, just copy that formula all the way down. And just to clean it up a little bit, I'm going to make these 4 decimal places. All right. So those are the present values of the free cash flows for the next 5 years for Nvidia, assuming our assumptions come true. If we sum them up, that would be the operating value first 5 years, which is the sum from D2 to D6. So basically we're saying that Nvidia is going to create $1.4 trillion worth of operating value in the next 5 years. I know that's probably a little aggressive. We'll put in more assumptions that are realistic later in the class, but nonetheless, that's what those numbers add up to. Okay? But that's the point. Nvidia doesn't just go away. Companies just don't go away after 5 years usually. So the assumption is we assume companies last forever. Okay? That's why we use perpetuities. So we're going to use a perpetuity for what's called the continuing value period. Okay? Now, the perpetuity that we're going to use, so we're going to call this the continuing value. Is the key value driver equation. Okay? This is the important equation which we had talked about earlier in the semester, right here. Spent a lot of time on it. Okay? That's just a rearranged growing perpetuity. Okay? So that's the equation that we're going to use to value the company or any company long term. It's just a growing perpetuity. It's got 4 variables in it. We need a profit, which is a NOPAT. We need a G, we need an ROIC, we need a WACC. Those are the 4 things we need to estimate continuing value for a company. Now this is going to change as we go to different companies. The equation won't, but the company data will. So I'm going to actually put these 4 numbers to solve for this cell on the assumptions tab. So I need those 4 numbers on the assumptions tab. I already have a WACC there. What I'm missing is I'm missing a continuing value NOPAT. I'm missing a continuing value ROIC, and I'm missing a continuing value G. And those are going to be yellow, because again, they will change if we were to do like Nike as a next company. Right? So here's the point. I already have a placeholder for WACC. I need a placeholder for my NOPAT. So my assumption for my NOPAT, the continuing value assumption starting, is my year 6 NOPAT. That's why we do that plus 1 year period. Okay? So basically, my NOPAT in B5 off assumptions equals off the TII, the final year, 2030, column M5. That's my 2030 NOPAT forecast. That's the beginning of my continuing value period. Okay, it's a placeholder. For ROIC equals, off the economic profit tab, 2030, continuing value period, M15. And for G, just put in 3% as a placeholder. Okay? So I'm going to format this, currency 1 decimal place. I'm going to format this as a percentage. And I'm going to format the 3% to 2 decimal places. All right? And if you're wondering, you're like, yes?
Could you show the continuing value ROIC in the...
That is just the economic profit ROIC, which is EP M16. Okay? Yeah.
What was the growth one again?
There's no formula for it. We're just putting 3%. Just putting 3%. So back to assumptions. One of the assumptions when a company is mature is it tends to grow with the economies. All right? U.S., European economies, generally 2 to 3%. I'm just using 3% as a placeholder. We will put in a more accurate G a little bit later on, but I'm putting in a mature number as a starting point. Okay? All right, so this is the hardest thing you're going to have to do today. All right, and I did this in the last class. So let me grab their model. This formula is the key value driver formula from the book. Okay? Growing perpetuity. Copy. So I'm going to put in the valuation over here, there's the formula. Okay? We got to put that formula with the correct order of operations on the valuation tab into cell B9. Okay? Using those 4 numbers. Okay? So here's how you do it. So equals, left paren, profit, so we're going to work off the assumptions tab. Profit is the NOPAT, B5, times left paren, 1 minus the growth, which is B7, divided by the ROIC, which is B6, right paren, divided by left paren, WACC, which is B4, minus G, which is B7, right paren, enter, $54 trillion. Okay, so if Nvidia were to hit those four assumptions, they'd be worth almost 55 trillion in perpetuity. That's the formula with the correct order of operations. I'll leave it up there. This is being recorded on video, so if you need to pause the video later, go back and look at it. It's right there on the screen. Okay. As I said, I usually get it right about 5 out of 6 times, but every now and then I screw something up with a parentheses. But that's basically what you got to get. Questions? So we just put that formula into that cell. So that's basically the value of Nvidia long term, assuming those assumptions come true, as of the beginning of 2030. Okay? But we're doing this valuation back in 2024. So I still have to present value this to today. Okay? So I use the same discount factor as 2029 equals C6, and I take that value, B9 times C9, and the present value of the perpetuity period is 34 trillion today. Okay? Now, just as a reminder, you're like, well, why is he using the same discount factor? Why don't you use another year? And the answer is because a perpetuity actually discounts the current year. So when you do a growing perpetuity, you're actually discounting to January 1st, 2030. So if you discount that year again, you're double discounting. It's a common error people will make. Yes, sir?
Can you show the equation of D9?
Sure. All right, so our next step is to take the first 5 years in present value, the continuing value in present value, 6 into perpetuity, and add them together, and that's going to be the operating value of Nvidia based on its free cash flows. Okay? So basically down here in A11, we'll call this the operating value. And the operating value is equals D7 plus D9, 35.7 trillion. I know it's a ridiculous number. We'll put in more realistic values later. Okay? All right, so back to Modigliani-Miller. Operating value plus non-operating value equals enterprise value. So our next step is to estimate the non-operating value of a company, in this case, Nvidia. Okay? Here's where TFI helps us. Okay? On the TFI, we have listed the non-operating assets and liabilities, A10 through A12, based on a standardized balance sheet. Okay? Those are the non-operating assets we got to value. Okay? So it's the excess cash, the non-operating assets, less the non-operating liabilities, and long-term investments. So back to our valuation, starting in A13. A13 on valuation equals TFI, A10, A11, and A12. I'll be lazy and just copy and paste them down. Those are the 3 non-operating items. Another assumption that is typically made. I invested in Nvidia because they're a semiconductor who makes chips that everybody needs. I don't invest in Nvidia because they have a bunch of cash in the bank. Okay? They're not a good company to manage cash in a bank. They make products. So the assumption we make for non-operating items is that they're NPV 0 in the future. Right? Companies aren't good at non-operating things generally, so they're kind of worth what they are today and not going to really grow. They're going to earn their cost of capital on them over time. It's just an assumption we make. Every now and then, like Microsoft got lucky, struck lightning with ChatGPT, and ChatGPT is worth a whole lot more than they put in. Okay, we can make an adjustment for that value, but that's an exception. Most companies, non-operating assets, NPV 0. Okay, but we can always change it. Right? So what that means is the present value is the currently reported value. So for the non-operating assets for Nvidia, excess cash, D13, equals, from the TFI, G, last reported excess cash, G10. Non-operating assets, G11, off of TFI. And long-term investments, G12. Again, Nvidia doesn't have any, but another company might. And so again, I'll format these $, 1 decimal place. And if I sum them up, that would get me my non-operating value for Nvidia, which is the sum of the three, 32,805.6. Yes? Question? All right, so if I take my operating value and non-operating value and add them together, that gets me something called my enterprise value. Okay, so basically if I take the 36 trillion and add the 32 billion, I get an enterprise value 35,689, 681.79. Okay. By the way, this is actually instructive to another point. Like when you do these valuations, it's really important to get the operating value right because the non-operating value for most firms is not the substantial amount of companies' values, right? I'll show you another thing. For most companies, the first 5 years are not where the real value is. It's the continuing value period. That's why getting the continuing value right is also going to be important when we do our valuations. That's the most important number to the valuation of any company right there, right? Because that continuing value for most companies, 60 to 90% of a company's value is going to be in continuing value, okay? So basically, that's where the action is going to be, but nonetheless, we have to kind of account for all these other items, right? Now, back to Modigliani Miller. Operating value plus non-operating value equals enterprise value. That equals the debt and the equity value. So here's the point. Common equity is a residual. The shareholders get what's left after everybody else has been paid. So we subtract all the debt, and we subtract the non-common equity, and whatever's left belongs to the shareholders. Okay, very straightforward process. So again, this is where TFI helps us. The debt currently owed equals TFI. We got to pay off the retirement-related liabilities. We got to pay off of TFI the interest-bearing debt. We got to pay off, we're solving for common, so we skip that one, the preferred shareholders. And we got to pay off the minority shareholders. So those are the four people that are entitled to get the money before we get it as common shareholders. So they have to be paid back first. Again, the amount owed today, so D21 off valuation for retirement equals TFI, column G, 15. Interest-bearing debt off of TFI, column G, 16. Preferred stock off the TFI, G, 18. And TFI, G, 19 for the minority interest. Okay. Now, Nvidia doesn't have any preferred stock minority interest of retirement, but another company might. That's why we put those in as placeholders. But here's the point. Again, I'll format these as $, 1 decimal place. I then am trying to solve for a common equity value, which equals the enterprise value minus those four things. So the sum of D21 to D24, or 35.678, etc. So here's the point. If I take that equity value, divide by the shares outstanding, I get a model price per share. Okay. Now here's where we're going to go to Bloomberg. I need an accurate share count for Nvidia. I need to know how much shares they have outstanding today, right? And it's going to change by company. So I'm actually going to make this an assumption. So my next assumption down, shares outstanding. That's going to be yellow. Go to Bloomberg. You're going to need, for future assignments, 3 screenshots minimum. This is one of the 3 screenshots, DES. So you're going to go to Nvidia You're going to go to DES. And right here, it says shares outstanding, 2.5 billion. So it's just a quick and easy place to get the current share count for any company, DES screen. Okay? So again, 2.5 billion, 2,500. So in our model, 2,500. Now for DCF valuation purposes, for cell D28 author valuation tab equals, I'm going to refer to that assumption because that'll change by company. So my model share price is the common equity value divided by the share count, $14,271.45 a share. So if all these assumptions were to come true, they'd be worth a whole lot more than 900. They're clearly not going to be these assumptions, even in mem stock world. All right, does everybody get to this point? The good news is if you got to this point, you pretty much have a functioning valuation model. Most of the process of what we're doing, you've now done. This is real world and it would work for any company, okay? That we built an enterprise DCF. Here's our next step, right? Today, Nvidia share price is trading at 902, real time, up here on the top of the screen, okay? We're going to do what's called an as-is valuation, which means I need my model to be that price, not 14,000. Okay, got to be exact. It's called an as-is valuation, right? So I'm going to show you the process that we're going to use to do the as-is valuation, right? But this is also why screenshots come in. So we're also going to take a screenshot of the DES screen for two reasons. One, it's got our share count, but two, that price at the top of the screen, when you take the screenshot, is what you're valuing your model at that time. When I did this in the 11 a.m. section today, the share price was $8.9944. Okay, we're going to have slightly different numbers in the 11 a.m. section than this 2 p.m. section. If you do it tomorrow, that share price could be $8.75. It could be $9.30. Like, it's bouncing around, real world. So as you're doing these valuations, your share prices are going to change. One of the reasons why we're requiring screenshots is it's what was the data at the time of your valuation. Okay, so this is the data at the time of our valuation. But just to be consistent for this homework assignment, we're going to value it as of the 11 a.m. section today. Okay, so the screenshot, Nvidia DES, that you would have taken, I've done it for you here. Some downloads. This morning, it was at $8.9944. Okay, that was the share price that we're going to value. So our next assumption that we're going to use is the current share price. And so this is going to tell us the price that we are basing our model on. $8.9944. Question?
So we don't need to take like a screenshot or anything?
For this assignment, no.
Okay.
However, next week, I might give you Nike as an example. And so if you're doing Nike, you'll have to take 3 screenshots for Nike. This is the first of the 3. Because when you're doing, I got 180 people across the 4 sections, 180 people are going to do Nike at different times. You're not all going to have the same price. And so how do we grade it? We grade you based on telling us what data you had at the time of your valuation. So very important to turn in the screenshots. Okay? So back to this. I'm also, for my purpose, putting in that I'm trying to match this model to be $8.9944 for the first model. Make sense? Okay. Now here's the point. What we're going to do, process-wise, is we're going to start adjusting these ratios so that this price becomes $8.9944. All right? And I'm going to find it really annoying to change a ratio and then go over to that worksheet, change a ratio, go back and forth to the worksheet. So what I'm going to suggest that we do, ratios, down here at the bottom, cell F26 equals assumptions, current share price, copy, paste, which is the $8.9944, And then one row down equals DCF valuation, model share price equals D30. So that way, every time I change a ratio, that model share price will adjust. You'll see it on the screen. And our goal here is to get those two numbers to match. Okay, so that model share price eventually has to get to 899.44. Okay, now when we do this, I'm going to give you the 80-20 rule, or maybe 90-10 rule. These are the most important things to change that will have the biggest impact on your valuation. Okay, and the first one basically means we got to get free cash flow right. And you can see this on DCF valuation. Like, I need to get this enterprise value, I need to get this value right more so than I get that value right. Okay, and that's based on free cash flows. Free cash flow is gross cash flow minus gross investment. On the ratios tab, the first three ratios that are the most important are highlighted in gray. All right? Nobody bothered to ask me early in the semester, like, why are those three rows gray? You just kind of took it for granted. I'm going to tell you why now. Because those three rows help you do gross cash flow. Revenue, EBITDA, taxes are tax rate, are the three most important things to forecasting gross cash flow. That's why I've highlighted them. Those are the three numbers that we got to get right. Okay, those are the first 3 of the 5 ratios that are really critical. So let's talk about the first one. Do the easy one, tax rate. They paid 12% tax rate last year. I need a realistic tax rate in the future. Well, by the way, we're not the only people trying to figure this out. Wall Street's trying to figure this out too. And the company knows that people need to figure out the tax rate. They're trying to figure it out. So sometimes companies will give what's called guidance. They can't give you an exact number, because if they give you an exact number, they're wrong, they'll be sued, but they might give you a range or an estimate. So Bloomberg, there's a screen, GUID, which is company guidance. Did the company tell Wall Street anything about the tax rate? And you can see that in the middle of the screen, they are telling Wall Street that the tax rate going forward should be between 16 and 18%. Okay, so they're giving a range, right? Because we're trying to do the real world numbers, we should use somewhere in that range for our tax rate. Okay. Now, I'm not requiring this as a screenshot, because when you do, for example, we do Nike next week, that all of you 182 people are going to use the same tax rate. So I don't really need a screenshot of this one, right? But the other 3 I will need you to turn in. Now, if you want to do an extra screenshot, it doesn't hurt. But nonetheless, I'm not going to require this screenshot, right? But you need the guidance. Make sense? So company said 16 to 18. How about we just use 17? Split the difference. Anybody disagree with that? As you go through this, you're going to have to start using some judgment. So it's not just pure plug and play. All right? So back to this, 17%. I'll use the middle of the range. You can make an argument, maybe we use the high end of the range. So here's the point. Cell H10, 17. By the way, when I did that, share price just went down to 13,000. Higher taxes, lower value. That was a midterm question, by the way, remember. All right. Next, we need realistic EBITDA margins, and we need realistic revenue growth rates. Again, the analysts on Wall Street are trying to do the same thing. And if you remember, these sell-siders for Nvidia, ANR, have models that look a lot like this that we're building, that they're forecasting Nvidia too. Okay? And so they're forecasting revenue. They're forecasting EBITDA. Except these people probably have a better understanding of what it's likely to be than we do. They're specialists in this industry. And so I don't think we need to recreate the wheel if we're trying to get the baseline that Wall Street's using. So these people create models which are summarized on EEO. There's the baseline. It's the wisdom of the crowd. So there's the next 5 years of revenue that's forecast today for Nvidia. There's the next 5 years of EBITDA that are forecast for today for Nvidia. Row 13 and row 17. So we're going to use the baseline in our model. So this part just involves some transposing. So back to, and this is screenshot number 2, by the way. So we take screenshot, EEO, save. You're going to submit this for any company going forward. Again, for this assignment, we're all using these same numbers, so I'm not requiring the screenshot for this assignment, but starting with future assignments, you'll need a screenshot of your EEO. Okay? So back to this. So we're going to go to our model assumptions. Down here, B11 equals B2, previous year, plus 1. Starting with C11 equals previous year plus 1. And I'm going to copy this out for 3 more years. So these are my years, 2025 through 2029. Okay, just 5 forecast years. Again, using relative references. And if somebody doesn't mind, can you close that door? It's that loud over there. So what do I need? I need the forecast, the consensus. Thank you. Consensus revenue and the consensus EBITDA. Because if I take my consensus EBITDA divided by my consensus revenue, I get my EBITDA margin. So I'm telling you, the analysts have already given us the EBITDA margin for Nvidia going forward. We just got to do a little bit of dividing here. Okay. So now we just put in the numbers. 2025 revenue 110,038. So 110,038. 2026 revenue 133,152. 2027 is 150,967. 2028 is 169,161. And for 2029, I got to go over 1 column. 171,699. For EBITDA, so already in 2029. 2029 EBITDA 121,621. I'll start back in 2025, going back over a column. 2025 EBITDA 73,312, or 72,312. 72,312. 2026 is 87,565. 2027 is 97,342. And for 2028, 109,118. I'm going to make these cells yellow. And I'm going to format them with $1, 1 decimal place. So, EBITDA margin 2025 equals the EBITDA, which is B13, divided by revenue B12, 65.7%. Copy, paste, growing to 70.8% over the 5 years. So based on the consensus estimates, those are the EBITDA margins for the next 5 years. Okay? So my second number that I'm changing, so I'm coming here to my ratios, and I want these 5 numbers here to here to match those numbers. Okay? So starting with H7 of the ratios equals assumptions B14. And I'm going to copy that to L7, and I'm going to unyellow those numbers because they're actually coming from the assumptions. Okay, so that's the point. Those are the 5 years of EBITDA margins for Nvidia, assuming those assumptions come true. They're actually higher than they are today, which means share price is actually going up. Okay. Now, the other thing I need is I need realistic revenue growth rates. So that's the point. I know the revenue. Here's the revenue for the next 5 years. So based on these revenues, I should be able to back out of the growth rates. The formula for percentage change, revenue growth rate, is current year minus previous year divided by previous year. That's just algebra. Okay? So we use that formula for 5 of these years. Okay? So basically, in the assumptions for revenue growth rate, or sorry, ratios, take these 5, no yellow, get rid of the yellow. So the 2025 revenue growth rate equals left paren, current year revenue, that's assumptions B12, minus last year's revenue. Now we don't have the historical data on this page, that's on the income tab. So income G3, right paren divided by income G3, last year's revenue, they're going to grow 80.6% next year. That growth rate leads to that revenue. Okay? Now it gets easier when we get to 2026 growth rate. Equals left paren, assumptions, 2026 revenue, which is C12, minus B12, 2025 revenue, divided by B12, 2025 revenue. They're going to grow 21% in 2026. And by the way, I can either copy the formula over or do this again. I'll do it again. Equals left paren, 2027 revenue, minus 2026 revenue, divided by 2026 revenue. They're going to grow 13.4% in 2027. And I can now just copy and paste over 12% and 1.5%. That's the next 5-year growth rates, which, by the way, if they grow at those rates, notice on my income tab, these now match the numbers from the consensus. Okay? And oh, by the way, when we put in the growth in margins and tax rate, our share price, 467. We're not quite at 899. We're now below it very quickly. Questions about that? Those are 3 critical assumptions. Yes. So for the 2025 growth rate, that's the only one that's a little tricky. Same formula. But what you're going to do is you're going to take assumptions B12, which is the 2025 revenue forecast, minus the 24 actual revenue. And unfortunately, we don't have that in the assumptions tab. We're going to go back to the income tab. So that's why minus income G3 divided by last year's revenue, which is income G3. That's the only one that we don't really have off the assumptions tab. The others, you create off the assumptions tab. All right. 4th thing, and this is your 3rd screenshot, is we need a more realistic WACC. Okay? So right now the WACC is 9.9. And in our model, but if we go to the WACC screen, it's 13% in the real world. So I got to put the current WACC into our model. So screenshot, save this, take a screenshot, and then put in 13%. When I do that, my share price is down to 317. Remember, I got to get to 900. But nonetheless, higher discount rate, lower value. But got to put in a more realistic WACC. Okay? Yes. For which one? The WACC? There's no formula. You just look up the WACC and you type it into cell B4. Current WACC. All right. By the way, I did skip over one thing. I told you we did operating value. Free cash flow is critical. I said there were 3 ratios that drive gross cash flow. These are the 3 in gray. There's also gross investment. Okay? Now, back when we built this model, and I told you all these balance sheet ratios were a percentage of sales, I said there were 2 reasons why we're going to do it as a percentage of sales. Here's reason number 2. Okay? As the balance sheet, as revenue grows, the balance sheet grows. Because the balance sheet is now a percentage of sales. Okay, so when you get a bigger revenue, I get a bigger balance sheet. The change in the 2 balance sheets is your gross investment. So we don't have to forecast gross investment. The model will do it for us because the balance sheets are going to grow with revenue. This is where the final number on row 24 comes in. That's the productivity of the firm. Right now, Nvidia, in column G, row 34, is spending 35 cents per dollar of revenue on invested capital. Okay? In the future, it falls to about 30 cents based on our forecast. So the question is the balance sheet big enough? Meaning, if the company's productivities usually stay about the same, then in the future, they should be spending 35 cents per dollar of invested capital. They shouldn't be spending 30 or 29. So that's where I could change, for example, PP&E as a percentage of sales higher. I could change inventory as a percentage of sales higher, accounts receivable, DSOs higher, to reflect current levels of productivity. Okay? But this is a judgment call. I'm not going to muck with it for Nvidia for two reasons. 30 and 35, not that big a difference. But more importantly, Nvidia, as we saw with their margins, are getting bigger and bigger. And because they're making so much more in margin, I don't think they correspondingly have to invest as much because they're basically selling high price chips. Okay? And so it's not about the production capacity, it's just about the prices they're charging for the high volume right now. So I actually think their productivity is getting better because they're getting higher prices for similar volumes. Okay? So a different company might not have that assumption, but I'm making that bet because you can see their EBITDA margins going from 56 to 71. And that's just, you don't usually see that for big companies growing that fast. Okay, this is an exception, right? So I actually think they might actually get a better productivity because of this. I'm going to leave the productivity alone. But that's the idea. For most of your models, you're probably not going to have to change the balance sheet ratios, and it actually just kind of helps you with the gross investment. Okay? So we forecasted growth rates, EBITDA margins, tax rate, WACC. Here's the final variable that matters. Column M is the perpetuity period. This is what's driving the key value driver formula. Okay? So I need these numbers to be realistic. Tax rate, okay. I don't think the tax rate's going to change in perpetuity versus what it is now. EBITDA margin, it might. We need to know that one. And growth rate, the year 6 1-year growth rate doesn't matter. The G is what we're actually going to try and get to that's going to matter a whole lot more. Okay? And I'm just saying if we left it at 1.5%, they're already growing another 1.5%. I don't think it's going to make a difference if we made that 2 or 3. Okay? So here's the point. This number, though, becomes really important. And here, and I hate when professors do this, but here's where you're going to have to kind of trust me for a second. In the 4th section of the class, we're going to talk about multiples. And one of the things you're going to learn is that multiples are just the key value driver equation rearranged. Every real world multiple is based on the key value driver equation. Okay, that's the academics behind it all. Okay, and we're going to spend a lot of time understanding that, going through that. But what I'm going to tell you, one of the things that will come out of this is here on the assumptions tab, if you take the enterprise value to revenue multiple, the real world one, and you divide that by the enterprise value to EBIT multiple, you get the perpetuity EBIT margin. Okay? That's just math. Has to work out that way. Okay? So here's where the trading multiples for publicly traded companies will start to help us. Okay? So we're going to use forward year 2 and 3. Forward multiples are more important than historical multiples. You're worth the sum of your future cash flows. And forward year 1 is dirty. Remember, for Nvidia, 2025 has already started, right? They have now a combination of actual and historical data. It starts with the second forward year that it's a clean forecast. Clean forecasts are more normalized. So in the second forward year, what's their EV to revenue multiple? Back on your DES screenshot, for EEO screenshot, based on the share price at the time, which is why we're using the screenshot, this was the EV to revenue multiple for Nvidia in the second forward year, 2026. They were trading at 16.7 times revenue. Okay, so basically here, 16.7. In the third forward year, they were trading at 14.73 times revenue. This morning, they were trading at 25.96 times next year's EBIT. forward year 2 EBIT. And they were trading at 24.52 times third year EBIT. Those are the forward multiples this morning based on that share price from the 11 a.m. section, 899.44. Okay? So what I'm telling you is hiding in plain sight. The EBIT margin in perpetuity is the enterprise value to revenue multiple divided by the enterprise value to EBIT multiple. Or 64% and 60.1%. So what I'm saying is, to make the share price work based on the trading multiples, their perpetuity EBIT margin, their operating margin, needs to be between 60 and 64%. Because if it's not in that range, then the share price does not work to the cash flows. Okay? So again, we're using the real world data to kind of help us estimate the perpetuity margins, because that's what makes that price work. Question?
And we're using 2026 and 2027 because they're the most recent.
We're using forward year 2 and forward year 3 for whatever company. Now, Nvidia is, their current year ended basically in January, so they're in fiscal 25, even though for everybody else they're in fiscal 24. If I were to ask you to do Nike, this number might be 2025 and 2026 for the second and third year. That's why we're using relative references. Second, third, forward year. That's the data that matters. Count over columns in Bloomberg. It'll help you. Great question. Other questions? So here's the point. On the ratios tab, this number is the EBIT margin. It's the operating income margin. Specifically, it's M9. That is the critical number. That's the perpetuity operating margin. That number needs to be between 60 and 64%. And right now it says 68. So I got to lower it. Okay? But here's the point. That cell is not yellow. If I directly change that cell, it's going to break my model. So the question is, how do I make that number between 60 and 64? I change the EBITDA. So I change the EBITDA, M7, to make M9 between 60 and 64. Right? Now, right now, the current share price, and this involves judgment, in our model is 317, and we got to get to almost 900. So if I'm thinking perpetuity, I probably don't want to do 60, makes a bigger gap. I'm probably going to keep 64 in there because I'm trying to get to 900. So I'm going to use the top of the range. But this is where judgment comes in. You don't always have to use the top of the range. Like, you're going to get a range, you got to decide where in the range you want to use, right? So back to this number. If I want this number to be about 64, what I'm going to do is I'm going to change this to 66.4. And that makes it, close enough with rounding, 63.9. And when I do that, I'm at 303, and I need to get to 899. But these are the 5 critical numbers. Now you can change other things too, but you got to really change. Growth rate, EBITDA margin, not in this order, tax rate. You need to change your balance sheet ratios if necessary, but then you need to get your WACC in there, and then ratio number 5 is this perpetuity margin. The final step is G, the continuing value G, okay? And I'll just go back to key value drivers. And this is going to be kind of just, again, it's not always plug and play, but here's the point. When we do key value drivers, we need to know those 4 parts of the equation, which, like I said, is like 70 to 90% of most companies' values, is that equation. So I'm going to get that equation more right. I am telling you, it is easier to forecast the ROIC than the G. And oh, by the way, when you did key value drivers, we started playing around with that Excel model, and you changed the G from like 3% to 5% to 7%, the values could go crazy, okay? So the values are much more sensitive to changes in G than changes in ROIC. And ROIC is usually easier to forecast than G. So here's again the 80-20 rule. Most of the time, our process, which we're going to do for NVIDIA, is estimate an ROIC, solve for a G. That's what we're about to do. However, every now and then, you're going to have trouble where you're not going to be able to solve for the ROIC very easily. And so the process there is estimated G, solve for the ROIC, right? But you're going to eventually have to estimate those two numbers. And I'm telling you, it's easier to estimate the ROIC most of the time than the G. And next week and other weeks, we'll start giving you exceptions for this. So it's not going to always work this way, but Nvidia should. So here's our final step. We have an ROIC in perpetuity based on all these other numbers we've done. Now we have to solve for the G. So basically what we're going to do is we're going to go back to our Excel model. We're going to go to our continuing value G, and we want this number to change so that our share price becomes $8.9944. We have two ways to do this. I could just start plugging in higher G's to get my share price higher, or what I'm going to recommend is we use GoalSeek. So we're going to use GoalSeek here. So to use GoalSeek in Excel, do the same thing, Tools, GoalSeek. When you use GoalSeek, what we're going to do is we're going to set cell, DCF valuation. I want my share price, which is D30 in the valuation tab, to become $8.9944. That's the value. And I want Excel to continue to iterate by changing cell B7 off the assumptions until it gets the share price to be $8.9944. When I hit OK, the answer is 10.62%. At a 10.62% G, my model is now $8.9944. That's GoalSeek, yes. So this works, this is not just our model. You can use GoalSeek for anything. But with GoalSeek, you go Tools, GoalSeek. Now I have the Mac version, the Excel version might have GoalSeek somewhere else in the menu. But you choose GoalSeek. And what you do is you say, okay, what GoalSeek says is I want to set a cell, which is a formula, D30 in my model, to have the value that I want, solve, so you get to $8.9944 by changing this cell, B7. So what Excel is going to do is going to iterate B7 with numbers until it finds a value of $8.9944 in the DCF valuation tab. And that answer is 10.62%. That's called GoalSeek. Then you didn't do it right. Right? Yes?
And this wouldn't make it like a circular reference?
There's no circular reference in GoalSeek. There shouldn't be. Okay? Because what you're doing is no different than if I did this. If I did 5%, what's my share price? $3.50. If I did 9%, what's my share price? $5.83. Like I could just manually do this and jump back and forth. That's one way to do this if you can't figure out Excel. All right? But I'm just telling you, rather than spend a few minutes going back and forth and plugging in, you could use GoalSeek and Excel will do 100,000 iterations in about a millisecond and it will get there much faster than you will. That's the whole point of GoalSeek. Undo, undo. And this is the other reason why this is important, is because, undo those two changes. There we go. This is your homework assignment. This is where you have to be today and turn in for homework 8, right? And so the TAs are going to grade 2 items. They're going to look for 10.62 and they're looking for 8.9944, and they have to exactly match. And the reason why I'm being a hard ass on this one is if you did this, you now have a working model that you can use for any company, right? So congratulations on all the work you did, because you built a real enterprise DCF valuation model, okay? And we'll start playing with this next week, right, with other companies. Those will be future assignments. But that's why I need you to get here, because if you're not here, then there's probably something you messed up along the way, and you're gonna have trouble with future companies. So that's why I need everybody to be at this point right now. Yes?
2 questions.
Mhm.
One is it a 10.16% realistic?
Well, that's a different question, okay? So two answers to his question. He said, is 10.62 realistic? I agree. That seems a little high. Okay. So here's the point. 10.62 explains a $900 share price. So the basis of your question says, I don't think Nvidia is worth $900. That's what you just told me. Because if you think that their long-term growth rate is not 11% a year, and it's more like 7 or 8% a year, you can actually come in here and say, you know what? Nvidia is not going to be worth $900 long term. Like right now, maybe people are saying they are, but long term, they're going to be worth half of what they're worth. Okay? And that's called the target model. And that's one of the files that we're going to work on Monday. That's where we're going next. Okay? But today, we're going to do the baseline. And the point is, and this is back to the answer to his question, it doesn't matter what you or I think. This growth rate explains the current share price. We're seeing $900 in the world today. And so I had to figure out what cash flows, what growth, what return leads to $900. And that's 10.62%, plus or minus a little bit, right? So our next question is, do we agree with this, right? So that's where we're going to go next, and that's why in every valuation, you're going to turn in 4 Excel models. This is the first one, okay? The second and third one are called the bull and the bear. Right? Let's say I'm hired by BlackRock to be a sell-side analyst. If I'm a portfolio manager, you guys know portfolio theory? To get a diversified portfolio, I need standard deviation. So what they're going to ask JP Morgan to do as a sell-sider is to say, okay, what is the best Nvidia stock price is going to be, high stock price, in 12 months? What's the low stock price in 12 months? Give me that range, that volatility, and that is going to be the bull and the bear. That's model 2 and 3 that we're going to build. Except you're going to do model 2, bull, and you're going to say what assumptions lead to that good scenario. So if it's going to go even higher than 900, how high can it go? And what are the assumptions that lead to that? Cash flow loss. Model number 3. Let's say it goes lower. What would happen to these assumptions that would cause it to go lower and why? And then I got a range. Target model, model number 4, where in the range do you think they're going to end up? That's now your opinion, okay? The difference between that target and the current share price is the buy, sell, holds. If your target, where you think they're going to end up, is within 10% of the current share price, it's called a hold. If your target is more than 10% above the current share price, it's called a buy. And if your target is more than 10% below the current share price, it's called a sell. And that's how they create the buy, sell, holds. But in order to get the buy, sell, hold, you need a target. And most people just do target. In this class, I'm making you do 3 additional models. Model 1, you're doing a baseline. People skip this process of the as is. I find it instructive because it allows me to say what he just did. You know what? The current share price seems a little rich, right? Because these assumptions seem a little crazy. Like right as you were coming on the break, I looked up DJT, ticker symbol. Right, this Donald Trump thing, okay? Now, first of all, he has $5 million in revenue last year and $46 million of negative profits, and it's worth $4 trillion. Like, I don't understand the DCF math. You really want to have fun with that? Put that into this model and see if you can come up with cash flows that represent a $4 trillion valuation, and you can't. I went to the analyst. There's no respectable analyst on Wall Street that's covering DJT. No one will touch the radioactiveness of that Ponzi scheme, okay? And that's the point. Like, the guy that's behind this, behind Trump, I know him, is the head of Susquehanna, who's a billionaire. Susquehanna makes all their money on options trading, which is actually true. And so basically, Susquehanna is viewing this as an option. DJT Holdings is only valuable if Trump wins the presidency. If Trump loses the presidency, it's worthless. But that's the point. If he wins, because he's going to use the presidency for his own personal fortune, he will use this company and make it valuable. And so that's the bet. The bet is if he wins, it's valuable. If he loses, you're going to be worthless. So there's your bet on DJT Holdings. All right. Otherwise, it's a Ponzi scheme. All right. But it's actually more of a Ponzi scheme because it's pump and dump. Because there's very, very few shares that are publicly traded right now. The float is really low, which actually means they can manipulate the stock price because a lot of people are buying it who don't know better, and this is exactly happened to GameStop, and then the price is shooting up, right? But regardless, the cash flows don't support it, right? Not today. But that's a different story. back to this. These are the cash flows that support a $900 valuation. Next week, 3 files, bull bear target. Next week, 500 word minimum paper. Why? Why the bull? Why the bear? Why the target? 3 screenshots. DES, WAC, EEO. Every assignment going forward, 8 files you'll submit. Today, you only have to submit this 1 file, and it has to exactly match between now and Monday. If you're here, you're done for today. If you're not here, you got to get here by Monday, 10 a.m., and we're going to pick up from here on Monday. Questions? Yes, sir. The ratios formula for which one? That should be, you just basically sell G11 copied over, which is the operating income times 1 minus the tax rate. Okay. Again, this has been recorded. This will be posted. And so basically, if you go back and look at anything, check it up on YouTube. I'll post the link a little bit later today. Okay? Don't forget, Bloomberg Trading Challenge, get below 300,000 of cash by end of day today. Okay, so if you haven't started buying stuff, start buying some stuff. All right, see you guys on Monday. Have a good rest of your week.